Happy Wednesday, everyone. Welcome to another edition, hashtag AskRobCo. Hope you're all well. Hope you're all enjoying your newfound freedom. Said a week ago how exciting it was. Looking forward to this week for a long time. Town is pretty buzzy. People are everywhere, outdoor dining and drinking and meetings and clients and coffees, and having had a meeting this morning outdoors, it was very nice. And you know, to do the basic things in life once more has been an absolute joy over the last 10 days. I've managed to play 7 matches of football in that time, which is really great, and I hope you're all enjoying our newfound freedoms. James, how have you been getting on, and what have you been up to?
Hi Rob, yeah, really good, thanks. It's been a busy week in the residential market. I've been out and about seeing, I've seen refinance deals this week. I've seen purchases. I've also been to see development sites. So a very busy week. There's a bit of a buzz in the air, I believe, with some good positivity and some. I think there's growing sentiment in the market actually in the last week.
Yeah, I think today and the data and intel and the vibe that we're going to be sharing is very much built on that market sentiment and really good positive data coming out from varied sources, but the National Statistics Institute, Bank of England, bit of data from our friends at Knight Frank. So let's go straight into it and see what the stats are for the last week. So as you all know, handout number 1 on the right hand side, and just looking at where the stats are now, they are following a trend that we've seen, which is the sales figures have been on decline. So we're now talking 2 weeks. We're at 128, that's week 14, sold column 128 on the right hand side. That's down again on last week. James's theory is that's on the back of a blip, either crossing over from the Christmas period and taking that time for the lull in transactions, or the Easter holidays and not as many transactions getting over the line. Combination of both, and James will give his view on that in a moment. Then we've got the new instructions. This is rebounded really strongly, really positively, and really well. So you had the Easter break that saw the downturn and the bank holidays, and boom, we're back in, and 386, I believe the top number for this year, if I'm not mistaken. That's a big positive, and that is only going to lead to more transactions and more sales as the year goes on. So all really good news from that side, even if the sales have seen another dip. James, anything you want to add on that?
Yeah, thank you, Rob. As we predicted last week, we anticipated, I think we said a 2 to 3 week blip on the transaction figures on the weekly sales. We're obviously into the second week now of this slight slump in the sales figures, although we do have some renewed positivity from the increased new instructions we've seen this week, which is in the top few weeks of the year, as expected, as things are starting to open up. There's now more stock on the market, which I think in turn will go hand in hand with more sales, more weekly sales. There's more stock out there, supply and demand. So there's always a lag between those sales and the new instructions. So we don't anticipate the sales to jump. I think after this slump, it's going to be a slow, steady increase to get back to those levels of close to 180 to 200 per week. So we're going to see how long that takes. I would anticipate it taking at least 6 to 8 weeks before we see some real jumps in the sales figures, just on the back of the inevitable lag from purchase to transaction.
Yeah, I mean, you and I have discussed this a lot in preparation for the weekly shows. I think there's a possibility that number could be lower, maybe between 2 and 4 weeks, because I just think there's a crossover of the lag and then the introduction of more properties and the timelines. And I'm curious to see. I believe it could be shorter, but it'd be interesting for us to follow that trend and see how it plays out. following that path and that data, really interesting piece that came out recently from Knight Frank, that London has taken top spot for luxury home sales in 2020, with around $4 billion worth of super prime transactions, beating both Hong Kong and New York to that coveted prize. Now, obviously, it's very subjective, and at what point are you defining super prime from prime? But all in all, I think we have continuously been talking up that marketplace because we are so strong in prime, super prime, in terms of transactions that we are either valuing, looking at, refinancing. And we have seen such a positive volume of transactions. It may not have led to price increases, but volume of transactions, especially upsizing from apartments or small houses to larger footprints. We've seen that trend throughout 2020 and 2021. So it's no surprise to me that London now tops their chart. And I think that's just a great reflection of the international clients that are looking to buy in the marketplace, the UK nationals. And if we take into consideration, and maybe you'll discuss this, the travel restrictions and the surcharge, it shows how attractive London is. James, what are your views on that?
Yeah, thank you, Rob. Well, 2020, as we've brought you news of, was a record year in prime and super prime central London. Just interested to get your view, Rob. It's been a slightly slower start to 2021 in the super prime market, but we have brought you statistics of those super prime sales in excess of those 2 million plus, 5 to 10 million plus sales. So there is activity in the market. But I just wanted to get your view, Rob, on whether you thought 2020 was the top of the market, possibly.
Yeah, so, everyone knows my views that for me, January 2020 prime, super prime was underpriced, really good value in terms of pound trading against other currencies, and off the back of 3 or 4 years of a downward trend following stamp duty changes and the Brexit position. So actually, for me, prime, super prime was underpriced in January 2020. So it's no surprise to me that the market was so attractive and should remain to be attractive moving forward, because I believe that we were at the bottom of a market rather than being at the top of a market in terms of pricing. And I believe that's been reflected in the volume of transactions that took place in that space. And then when you compare it to New York or Hong Kong and understand the dynamics and nuances of the way the US works, the US found there was better value in LA and Miami, thus the New Yorkers left to go to those locations. And in Hong Kong, with the political uncertainty, that also saw a decline in transactions. So the one thing that always repeats in uncertain and volatile market positions is that London is the safe haven for both UK and foreign money in the prime, super prime space. And nothing has changed in terms of the data and intel that we're receiving that says that's any different. And we see that on a daily basis. Why do we see that? Because we are valuing more transactions and more refinances in prime and super prime than we've seen for many years. And that's a pure reflection of what's happening on the ground every day, to the point that, this week alone, in the few days that have passed, I've been to 12 and to a 17 million purchase in prime central London and locations of houses with good footprints, and that's where the money's going. And it's a very positive trend that we will continue to report to you. What else are we seeing, James?
Well, no, I just want to follow on from that point very briefly. In terms of the holding costs and stamp duty, we could see longer holding periods for buyers in the super prime market, and especially this year with the 2% surcharge being introduced. It's going to be interesting whether the same transactional volumes are achieved in the super prime market. I think, like you say, Rob, I think pricing will remain steady in the super prime area. It's just whether we see that same volume of transactions.
Yeah, watch this space. I'm very confident on that marketplace. Everything, all the indicators say to me that is where the money is going, and it doesn't look like that trend is not continuing in the short term, especially for 2021. Let's move on to more domestic economic data. I loved the announcement this week that there is a record 180 billion extra savings in bank accounts at the moment, which is the equivalent of 10% of the UK's annual GDP, gross domestic product. And what I love about that, and what some economists are predicting, is a percentage of that money sitting in bank accounts is going to go on retail and spend and leisure, and it will also go on people upsizing and moving homes because they've got their deposits in place, or stronger deposits in place, and they're willing to make that change. So I'm really, really excited about that. I think what a position for an economy to rebound into post-COVID, or wherever we are now, semi-post-COVID. The fact that there's 180 billion extra pounds sitting in UK bank accounts, which again equates to 10% of the GDP of the UK, says to me that there is going to be a lovely rebound in the next quarter and the following quarter on spending. The UK economy, like the US, will spend for the remainder of this year, which will be a great short-term recovery for the marketplaces and the economy, and should give a lot of positivity and good sentiment to then see where we go in 2022 as the new reality of what the world looks like and the UK looks like, hopefully in a completely or predominantly completely COVID world, or however the COVID world looks like then. So I think that's great news, and I think that's really exciting for the next period of time.
Yeah, I think Q2 will be an interesting one to look back on. Well, obviously a lot of the market's reopening. Obviously, we've seen non-essential stores starting to reopen as well. And both in terms of the economic and fiscal performances for Q2 in terms of GDP, but also how the residential market is resurgent and how that's performed over the Q2. So during the summer, I'm sure we'll look back at that period.
Absolutely, really interesting to look forward to. In the last few decades, the low, predominantly last decade, low interest rates, and also a spending culture that has existed, hasn't allowed for the kind of savings that has been now forced upon people, because there's nowhere to spend their money, because they're not going out, they're not going on holidays, and so they've either pulled together resource or put it into investments or property to upsize. And so I think that's a key variable that hasn't been seen historically with downturns or uncertainty and volatility. And what a great place to start with 180 billion sitting in bank accounts. I mean, common sense says that that money is going to go somewhere, and it's not going to remain in those bank accounts. I can assure you of that. Last bit of economic data before, James, you bring us other news and what you've been seeing in the marketplace, is the UK economy returning to growth in February, despite restrictions. Office for National Statistics confirmed that output grew by 0.4% in February, and some of that is due to improved trading with Europe, even though those conditions are not perfect. And I just think that the fact that if the economic data is already showing that in February and probably March as well, that there's an upturn, even if it's a very small number and not near the levels that were expected, as we open up the economy and confidence and sentiment grows, that is only going to improve for sure in the short term. And that can only be good for opportunities, positivity, and market sentiment, which is fundamental in economies growing, and the headline data indicates that we're moving in the right direction.
Yes, thank you, Rob. So I just wanted to do a few minutes just talking about the area just south of the river, Elephant and Castle. So this week saw the iconic Elephant and Castle shopping centre being demolished, which was obviously rebuilt in the 1960s and slightly moved off the main roundabout following the damage to it in the Second World War. And there's two big master plan areas in the Elephant Castle. The first one is surrounded the town centre redevelopment, which will include the London College of Communications new hub, as well as the adjacent 1.25 acre site fronting the Elephant Road. This development is going to offer nearly 1,000 new homes, 979. This is going to be focused on the rental market, built to rent, in a scheme led by Delancey, with this element of the master plan area also including upgrades to the existing Elephant Castle tube station. Now, just to give you a bit of background on this site, the shopping centre was acquired in 2013 by Delancey for a figure of around £80 million, and this was tagged on to its neighbouring adjacent site at Tribeca Square, which is now fully built and is a mixed-use site comprising student housing, retail, parade, and also a build-to-rent block, which is up and running, backs onto the Haygate estate there, which is part of the Elephant Park regeneration master plan area. Now that itself is a further 3,000 new homes, a real, master plan, central London zone 1 location. Now, where we are now at this point in time, 1,600 of those 3,000 homes have been delivered to the market. So I think this is a real area, sort of one to watch in terms of how it performs in the new build market. And also, what's an interesting one, there's also the redevelopment and master plan area in the Aylesbury estate, just south of Elephant Castle, SE17. Now, we did have some news last month from TfL that they'd currently mothballed their plans for the extension of the Bakerloo line, which would travel through the Aylesbury estate, through New Cross into Lewisham. This has been mothballed for a period of time. We're not sure, but would have brought, obviously, greater transport links to the area. So this £4 billion project currently on hold there. But in terms of that area, that is a new swathe of residential new homes, one which we're going to see coming to the forefront of the market over the coming months and years. Just wanted to bring you some news on that. It had when it was first being developed, this area in around the sort of 2013 mark, it had the sort of slogans of Zone 1 location, but with its sort of value of Zone 3 pricing was its slogan there, with developers such as Lendlease and Delancey being at the forefront, leading the regeneration plans there. I was just going to add, Rob, obviously, we've got that regeneration southeast, further towards southwest, we've got Battersea. So these areas, there is a vast amount of new build homes coming to the market. They're going to be targeting young professionals, first-time buyers, and hopefully that, some of these new build schemes, they're going to be boosting the market, taking advantage of some of these 90% mortgages, 95% government-backed mortgages, which, could create that resurgence to the market. And I'm sure we're going to be out valuing some of these new build flats in the coming weeks and months.
Let's hope so. Let's hope so. Just a couple of things to add. For those that you can't watch live, we're on YouTube every week, so share with your colleagues. And we've been doing a lot of shows on Clubhouse. There's been really good finance and mortgage lending shows. So please contact me if you want to invite to that platform or to any of those shows. They've been really good. And we're lining up the guests for this show in the coming weeks, and some of the key points that we're going to reoccur. It's going to be, we're going to get our friends from Lunres on. We're going to be going back into detail with the cladding situation, because last week all of the lenders updated us on their new guidelines in terms of what they're reporting from the update provided by the RICS that we advised you on previously. So we're just going to relook at that, because all the lenders that we work with have sent us their new guidance, to which we're following. We just want to share some of that information, the generic trend from a guidance and lending perspective on that point. We will be getting a new homes specialist on, and we will be talking about some of the new home developments in and around London, and Battersea will be one of them. We are going to have a commercial special where we're going to bring in a few people to specifically talk about what's going on in the commercial market in the coming weeks, and have a big push for that. And we're going to do a special on leasehold enfranchisement, short lease properties, how they're looked at, how they're managed, what are the challenges, what are the trends, and what we're seeing there, along with the nuances of HMO, build to rent, care homes, etc. So we are lining up a star-studded guest activity over the next few months, so we can share with you the live intel, data and knowledge, add some value to your week. And at the same time, you can watch us on the other platforms. I think we've got a podcast that will be showing this coming up soon, and we've got the YouTube channels as well. So lots to listen to from us moving forward. We're very excited about all of that. Anything else you want to add, James?
Yeah, Rob, I just want to bring listeners a bit of an update. There's been a flurry of new lending products to the market in the past week or so, which does coincide, as we mentioned, with the lockdown easing and also the opening up of those non-essential stores. So there's been a buy-to-let lender, Lambay, has altered some of its minimum property value on its core products. This has gone from 75 to 65,000, so it's going to really impact those in some of the north of England, Wales, Scotland there, but also for its properties above commercial units, flats above commercial. Lambay is now increasing its loan to value from 70% to 75%, giving greater availability of mortgage finance. Build Loan has announced it's launched 3 self-build custom mortgage products in its partnership with Buckinghamshire Building Society, one which includes lending of up to £1 million. The products are generally for loans of up to 85% of the client's build costs. There is how they're structuring some of those lends. YBS Commercial further supports the retail sector with some of its newly reduced rates, announcing that it's been reduced its semi-commercial rate on its 5-year fixed mortgage rates. This is down from 4.7% to 4.35% and is available for loans between £500,000 and £5 million. Just lastly, Mansfield Building Society has announced that it has launched its new residential house purchase mortgage of 90% LTV. So as we've been bringing you more enhanced products on those high LTV products, which I think is a positive for the market, it opens it up to those low deposit first time buyers, which is obviously going to have a multiplier effect in the market and bring further transaction volumes and positivity, we believe.
Brilliant. Thanks for that, James. Thanks for all the data, intel and support and updates this week. Thank you for everyone for joining on all the platforms, building a really great community for you here. Risk, sales, credit, sanction, lending, property in general. So thank you all for that. Keep supporting us on LinkedIn, Instagram, YouTube, Clubhouse, and all the other platforms we're on. Keep engaging, keep asking questions. We will share everything we have to share with you, and if we're not, let us know like you do, so we can keep doing that for you. Enjoy your new freedom, enjoy having a drink at the pub, enjoy being outside in the great spring weather that hopefully is coming our way, even if it snowed at the beginning of this week. And we will see you all same time, same place next week. Hashtag AskRobCo, 1 p.m. Wednesdays. See you next week. Thanks, James.
Thanks, everyone.